Hi, Phil Weiss of Apprise Wealth Management here with a recorded webinar discussing how to overcome fear, doubt, and uncertainty while staying focused on your most important financial goals during a challenging financial climate. We certainly have had a challenging financial climate since about mid-February when the S&P 500 hit an all-time high. At one point, the market was down about 30%, maybe a little bit more. It's since recovered, but that recovery is somewhat top-heavy with some of the larger companies really driving some of that recovery and some of the smaller companies still lagging behind. There's a lot of uncertainty out there. Unemployment is way up. While the market is about where it was a year ago, I'm recording this on May 14th, the economy is not in the same place. So it certainly created a lot of uncertainty for investors. Who's this presentation for? Mostly those in their 40s, 50s, and 60s who are trying to find financial balance. Families who hope to maintain their lifestyle in retirement. Families who want to support their children's educational pursuits. Those who want to be more informed about what retirement might hold in store. Typically, people that I work with have $250,000 or more in investable assets. Really, one of the cruxes of this message here is that it's for people that are trying to balance competing financial priorities. Having a life with their family, saving for retirement, providing for their children's education. And this creates a lot of worry and uncertainty about how do I allocate, what do I do to be able to achieve those goals, which sometimes can compete. Here's what I'm going to cover today. First of all, building a solid foundation for retirement, having an understanding of where you are today, knowing where it is that you want to go, building what I call a retirement roadmap, and then once you have that roadmap, staying on course. My promise to you is I'm going to go through a step-by-step process and help you overcome the fear, uncertainty, and doubt associated with the challenging financial climate that we're facing today. Does this sound like you? You wonder about things like, I know I have to save for retirement, but investing in a volatile market is scary. I don't have a process that I follow in terms of my savings or my investments. I don't know how long what we're going through will last or what the future may bring. Believe me, you're not alone if you have that thought. I have too many competing financial goals, and I'm worrying too much and not taking care of myself or my family. And I know one of the things that I have found during this is that making sure that I have a regular routine, regular exercise really helps. Since the market started its volatility, I missed exercise in the morning one day. That was the day that was the hardest for me mentally of this whole period of about 2 months from a market perspective. I guess it's almost 3 months because now we're in mid-May. And that was the day that was the worst on a Monday through Friday, the one day I didn't exercise, because doing that exercise, it helps to take some of the fear and frustration out of your body and make it a little bit easier to do things. And having a routine really helps as well. The real problem, is you don't have a pathway to an informed retirement that can help you overcome the doubt and uncertainty you feel when the financial climate becomes more challenging. Once you have a pathway to an informed retirement, you'll realize things like how a down market can work to your benefit. For example, let's assume that you're adding $500 to the market every month. When the security that you bought was priced at $50, you bought 10 shares for your $50. If that security falls to $40, you're going to buy 12.5 shares. When we're investing for retirement, we're taking the view that over the long haul, we think the market's going to move higher. If you don't have that view, if you don't have that optimistic view, then it doesn't really make as much sense to save. So now the market recovers. So your original 10 shares at $50 each, they're now worth $50 and $500. But those 12.5 shares that you bought for $40 each when you invested that same $500, those are now worth $625. So by investing during both the high, that high and that low, you have $1,125 at the end of that period for those two investments. If you had done nothing, you'd only have $500. So not only would you just be even on that first investment, by investing throughout, not only do you have more money from making an additional investment, you also have additional appreciation. The combined return for those two is 12.5%. Another thing that having a process in place can help you do is lower your chances of buying high or selling low. Those are really the two worst things that we can do as investors. We don't want to buy high. We don't want to sell low if we can at all help it. And oftentimes our emotions get in the way, and that's exactly what we do. We sell low because we're scared, and we buy high because we get greedy. Another thing having a pathway to an informed retirement can do is help us be on the lookout for new opportunities. That can be with our investments, but it also can be if we feel more comfortable, then there's more opportunity for us to take on new hobbies or pursue new things. In the end, we're going to feel more comfortable about our future and be better positioned to help others as well. Let me tell you a little bit about my background. So first of all, I'm a CPA. I started my career with Deloitte, today it's the big four for accounting firms. Back then, it was actually the big eight. I'm also a CFA charter holder. Meaning I hold a Chartered Financial Analyst designation, which gives me a really solid background and understanding in investments. I've also been writing on financial topics for more than 20 years. It started when I wrote for The Motley Fool. I then worked as a writer and editor for T. Rowe Price. I was also an analyst covering the energy sector for Argus Research, an independent research provider. I then worked for another registered investment advisor, chief investment analyst, where I wrote a weekly blog for them. And now I have Apprise Wealth Management, where I also write a weekly blog. I created Apprise and my pathway to an informed retirement as a means of sharing what I've learned during my career. I specialize in helping retirement-focused investors embark on a path towards an informed retirement. So what does that pathway to an informed retirement look like? Well, here's an overview. It starts at point A, which is really where you're really not sure what the future might look like. It's a lot of uncertainty. We'll go through all the steps in more detail as I go through the rest of the presentation. But the goal is to get from that point A of uncertainty to point B, where we're much more informed about what retirement might look like. It starts with understanding where you are today. This means you should take a comprehensive look at all aspects of your financial life. So the first part of it is, if I'm working with somebody, is a strategy session. The purpose of a strategy session is to determine if we're a match. Does it make sense to work together? When you work with a financial professional, you want to make sure that they're a good match for you, that you have you have the ability to communicate, you're comfortable communicating, and you can communicate effectively with each other, that you have an understanding that they can help you meet your needs and achieve your goals, and also that you're the right client for that advisor, because you want to make sure that all those things happen, or else it's not going to be the kind of relationship that's going to be mutually beneficial. Once you get through that and you start to work on your plan, you want to start to understand what are your goals, your dreams, and your challenges. You want to be able to set goals, and you want to have a plan that helps you address your goals as well as meet your biggest challenges. And the other thing is you want to look at your current plan. And it's not just is your current financial plan up to date, which is what it says on the slide. It's also, have we considered everything? Do I have a will? Do I have advanced medical directives? Am I properly insured? What's my plan for investing and my savings? And what are my goals? And what am I trying to achieve? We want to build a plan that fits your goals and your lifestyle. No two individuals have the same plan. We have different goals and objectives. Our value systems are different. These factors matter when building your plan. That plan should be unique to you. Let's talk about goals. What do you want to accomplish? You can really break this into different pieces. Your short-term goals, those are things that are within the next couple of years. Your medium-term goals, those are things that are 2 to 10 years away. And your long-term goals can be 10 or more years away. Depending upon how young your children are, those long-term goals can include saving for your children's private schooling or college tuition and retirement. Short-term goals might just mean things like taking care of your car, starting an emergency fund, having a cushion in your bank account so that you don't overdraw and pay your bank fees. Some examples of medium-term goals. You want to have your full emergency fund, which is really an account that has ability to help you cover 6 months of your basic expenses. You can take care of home repairs and renovations, things like that. So here's kind of like the before and after. If you think about it this way, when you run a financial planning software, there's what's called Monte Carlo analysis. And Monte Carlo analysis is just a way of looking at all the different outcomes that you might get based upon the inputs, saying, if we look at all those different scenarios, what's the likelihood that you're going to be able to meet the goals that we set in the plan without running out of money? And oftentimes what happens is we start out with a big wish list. And so that probability of success can be low. Here at 65%, I've actually seen times where it starts as low as 0. But then we look and say, all right, well, let's prioritize and let's figure out what we really want to do and what matters the most to us and what changes and adjustments do we have to make to help us be able to do the things that matter most to us during retirement. When we go through that series of changes, then we can substantially increase the probability of a successful retirement. Which, like I said, is one where you don't run out of money during retirement and you're able to live the life that you plan during your retirement years. So how do serious retirement-focused investors avoid the roller coaster emotions of investing? It can be really hard, right? Like I said, we have fear and we have greed, and those emotions can be very powerful. They can cause us to make bad decisions financially. So one of the first things we want to do is understand what level of risk are you willing to take. So what's your risk tolerance? Is it very low? Is it very high? So very high would be like an 80 or 90% allocation to stocks, maybe even 100 if it's really high. More moderate would be somewhere around like 50-50, 60-40, so the 60 being the stocks and the 40 being the fixed income piece. But really we're trying to set something here that you're comfortable with. So when the market works against you, you're not as concerned and you don't feel the need to act right away. The other thing that you want to do is you want to marry that risk tolerance with your financial plan, because sometimes you'll find that you can take on less risk than you really feel that you're able to assume, because there's a willingness to assume risk and there's an ability to assume risk. So sometimes your willingness can be really high, but your need to assume that risk might not be as high. And so we can adjust that risk tolerance to allow you to still achieve your goals, but with much less volatility, hopefully, and still have the ability to achieve our desired end goal. So this is one of my favorite charts. It's the cycle of market emotions. It goes through and it talks about kind of the idea of what causes us to buy high and what causes us to sell low. And it's that fear and greed. So you can see on this chart that the point of maximum financial risk, that's really euphoria. That's when we're really excited. We feel great about our investments and what we're doing. And we want to just keep throwing more money because we've been doing great. And then the market turns against us like it has over the last few months. And anxiety and denial and fear set in. And as those emotions build, we get more and more concerned. We capitulate, we give in, we become despondent. And right around that point of what's really maximum financial opportunity, that might be when we sell because we're too scared. And then that cycle repeats itself. And that's happened over and over again in the markets. Markets never go, it's not a straight line up and it's not a straight line down. Markets go up and down, but over the long haul, they go higher more often than they go lower. So when you build a financial plan, part of the process is also to commit to regular updates and reviews. Your initial plan represents where you are at a point in time. It's designed to take you from point A, that point of retirement uncertainty that I talked about earlier, to point B, which is an informed retirement. Unfortunately, that path is rarely a straight line. It's important to commit to regular updates and reviews to make sure that you remain on track. It's also important to have someone help you bridge what I refer to as the knowing-doing gap. In other words, we often know what it is we need to do, but we have trouble doing it. So it's nice to have somebody looking over your shoulder to help make sure that you follow the steps and that you stay on course, and that if things change and deviate from the plan, that we make the right course corrections along the way. So that's the maintenance part, plan maintenance. So when I work with somebody, one of the things that we talk about is how often should we talk? So I promise clients that we'll have regular reviews. What does that mean? It means that every couple months, I will reach out. Could be a phone call, could be an email, Could be a face-to-face meeting, though I know we don't have a lot of those right now because of the quarantine and the pandemic. It could also be a Zoom call. I do a lot of virtual meetings. But it's important just to check in. You might not think that you have anything to talk about, or you might not naturally reach out, but things change and it's good to have somebody check in. I often find that when I reach out to people that it makes them think about things that they hadn't thought of, and it's just good to touch base. But it's also important to know that I have an open door policy. So if you know that I'm going to reach out every couple months, that doesn't mean you have to say, well, Phil's not going to call me for another 3 weeks, so I can't reach out. The idea is that if you need to get me, you reach out to me anytime you need to. You can send me an email. You can give me a call. If you want to get me more quickly, it's better to call because my email's not always open, but I will respond within 24 hours. And like I said earlier, we want to make sure that we have these plan updates to help make sure that you stay on course. It's important to formulate and stamp indelibly on your mind a mental picture of yourself that's succeeding. Hold this picture tenaciously. Never permit it to fade. Your mind will seek to develop the picture. Do not build up obstacles in your imagination. What this is really talking about is the idea of visualizing the future. I often go through this exercise personally. I firmly believe that having a vision of what your future will look like can help you achieve that future, the future that you envision. I think it's really important to do that, to try to look out and see what is it that I'm trying to accomplish? Where is it that I want to be, and what is it going to take to get there? Because if you can look at those, if you can think of those steps ahead of time, it can really help you achieve your goals. Another thing that's really important, I believe, is to work with a fiduciary. When it comes to working with an advisor, there's two different types. Fiduciaries are required to work in the best interest of their clients, even if it's not in the best interest of the advisor, because they're looking out for you. The other standard is what's called a suitability standard. And under a suitability standard, the person that you're working with is supposed to make recommendations that are suitable for you, but they may not be the best for you. They could be what's best for that advisor. Could be what pays them the most money. And sometimes you look at two different investments and their objective is the same, but the expenses of those investments are different. The fiduciary is going to be the one that picks the option that has the lower cost to you. And those costs matter. Costs affect your return. So it's important that you look at those. Somebody working under a suitability standard can pick an option that makes them more money, even if it's, even if that money that option is costing you is going to lower your returns. So let's go through a couple case studies of some clients that I've worked with and what this process has been able to do for them. So first we'll talk about Jack and Jill. Their goals were to reduce their spending on financial advice, have a portfolio that better fits their needs, and have a more informed view of retirement. That's what we tried to do. When I first met Jack and Jill, they were working with a broker. They were unaware how much they were paying for their investments. They also were not making any changes to their investment portfolio or that of their children. For example, I was told, so we're not paying anything in terms of expenses on our retirement, on the assets held in our retirement accounts. When I looked at it, it was loaded with high-cost mutual funds. The average expense ratio, and that expense ratio is what the firm that manages the fund gets paid for doing that, was around 2%. When I fill a portfolio with ETFs, that expense ratio is around 0.10%. That's a huge difference. So even though you might not be writing a check to anybody, you're still paying somebody for those investments that you have. So by switching their portfolio, we substantially lowered their costs of their financial advice. They had a portfolio that better fit their needs, so they had a more informed view of what retirement would look like. Now let's talk about friend Wilma. When I first met Wilma, she was unaware of the spending path her family was on. If it had continued, their debts would have grown. They would have started to take on credit card debt because they wouldn't have been able to pay their monthly bills. Now she and her husband have a better idea how much they can spend and save to live the quality lifestyle they want. They're better positioned to achieve their retirement goals. In other words, they have a budget to better manage their spending. They have confidence that college tuition bills for their children can be paid. They have greater confidence about their retirement and their investment portfolio. Once again, here's that pathway to an informed retirement that I talked about earlier. The one step I didn't talk about in more detail during the previous part of this presentation is that building part. So when we build, I mean, I talked about some aspects of it. I talked about the risk tolerance, but in addition to risk tolerance, there's changes and recommendations in terms of what changes should be made, and then looking at that roadmap and seeing if it gets us on that right path. And by that right path, if you think back to the earlier slide when we went from a chance of retirement success of 65 to 92%, that's part of determining if you're on that right path. So here's what we covered today. Building a solid foundation for retirement, understanding where you stand today, knowing where you want to go, building your retirement roadmap, and staying on course. My promise to you is that I would give you a step-by-step process that can help you overcome the fear, uncertainty, and doubt associated with a challenging financial climate. And that was what I refer to as my pathway to an informed retirement. Now you have a choice. You can do nothing, or you can commit to change. I can help. I've set aside time in the next few days to speak to you personally about how I can help you better manage turbulent market conditions. During this session, I'll work with you to craft a step-by-step game plan to help you build a pathway to an informed retirement. The cost? Absolutely free. Who's this for? Once again, it's for those in their 40s and 50s who are trying to find financial balance, families who hope to maintain their lifestyle in retirement, families who want to support their children's educational pursuits, those who want to be more informed about what retirement might hold in store. Excuse me. And typically, clients have $250,000 or more in investable assets. I got a good drink, apologize. Okay, I'm back. Why am I doing this? Giving is getting. Reciprocity is important. I like to provide just straight up coaching on the best ways to better manage turbulent market conditions. Plus, I know that you might want my help. If so, we can discuss it, see if it's a good fit for both of us. And if not, that's fine too. Here's a link to my calendar. You can use this link to schedule that free 15-minute strategy session that I talked about. Spaces are limited, so please go ahead and sign up for it as soon as you can. Thanks for listening, and have a great day.